Today on the show, I have the pleasure of welcoming back a good friend of the podcast, Matthew Sullivan. Now, Matthew was first on the show way back in 2016, episode number just 24, and we're at over 250 episodes now. So he was a veteran of the Investing in the US podcast all those years ago, and a lot has happened since then. But for those of you who don't know who Matthew is, let me reintroduce you to him. Matthew, like me, is an expat, and he's originally from England, and he's now making a ton of waves here in the United States. He is the founder and full-time CEO of QuantmRE, as well as the founder of crowdventure.com and the co-founder of 2 real estate funds. He spent a number of years working alongside Mr. Richard, or I should say Sir Richard Branson, at the Virgin Corporate Financing Team in London, United Kingdom, where he was appointed as the director and trustee of Virgin London's Air Ambulance. To top it all off, Matthew is the author of Head First, a roadmap for entrepreneurs. He's the host of the Hooked on Startups podcast, and he holds a private helicopter license. You could call him James Bond. I'm really excited to welcome him back to the show, but enough of me. Let's get him out here. G'day, Matthew. Welcome back. How you doing today, mate?
Very well. Thank you so much for that introduction. Of course, you realize that none of that is about me. I just thought I'd better write something interesting on these sort of introductions. So, I have to learn to fly a helicopter now, obviously.
No, I know. Well, but we had you on so many years ago, and it was good. It's, you were a local resident here in Southern California. So maybe you want to give the listeners a bit of an update on where you are today.
Well, I think thankfully, a lot of forward momentum. So I came to the US about 7 years ago, which I think probably about the same time as, around the same time as you actually. And really interesting to see the difference between London, which is where I was before, and Los Angeles in terms of the approach to business. So the one thing that really was astonishing was just how open and sharing everybody was, and how everyone would talk about their ideas and we met at one of the meetup groups that you originated in LA. So I really sort of cut my teeth very quickly back then with Crowdventure, which was one of the very first real estate crowdfunding companies. And what that did is that really gave me the instant sort of whistle-stop tour of crowdfunding, online finance platforms, securities regulations about what you can and cannot do in terms of private placements. But it also enabled me to find some fantastic real estate partners that I still work very, very closely with today. And so since then, which was almost, sort of several hundred years ago, it feels like now, I came across a real estate asset class as I was, building these companies. And that asset class is a huge $18 trillion untapped, which is always really exciting, which is the equity in single family homes. So then I sort of became, about 4 years ago, I started becoming obsessed by this asset class because I felt I'd sort of discovered, this incredible thing. And I didn't want to tell anyone about it, but B, I wanted to try and build the business. But so since then, I've really just been pretty much fixated on what has become QuantmRE, which is this company that now helps homeowners unlock their home equity without taking on more debt. And I'm sorry, that was an incredibly long answer to a very simple, short question.
No, don't apologize. And I want to get into QuantmRE and the evolution of this business. But I know when we had you on the show way back in episode 24, which was all about the Jobs Act in 2012. Maybe let's start there for today's conversation, because a lot has changed, right? When we first met, I don't know, probably 2014, I think we probably first met.
Yeah, better, yeah.
There was a massive flash in the pan of a lot of online crowdfunding sites. It seems, from the outsider's point of view, that a lot have come and failed at the death of online crowdfunding. Maybe can you walk us through what's the evolution been since 2012 and that Jobs Act and the rush to market of all these crowdfunding websites, and maybe who's left, who are the big players left in the space these days?
Great. Well, I think first of all, the Jobs Act has been a resounding success. So let's set the scene with that. And that's not a party political broadcast. That is, it is a fact. So if you look at the amount of capital that has been raised through online platforms that have been facilitated by changes in regulations that have come about from the Jobs Act, billions of dollars have been invested that otherwise may not have been invested. What you were referring to is completely correct, which is this life cycle of businesses that have come and gone, not necessarily in the wake of the Jobs Act, but companies that were set themselves up, hoping to become successful because of the changes in the Jobs Act, but just didn't make it for a number of different reasons. And raising money is incredibly difficult.
Amen.
And we all know that. And speaking as one of the companies, crowd venture, that was a stepping stone for me. So that it's still there. We still do a small amount of business, but that was something that really was incredibly useful to me because it helped introduce me to, as I said earlier, how the legislation works, who the people are, and it gave me this ability to just get started. And as every entrepreneur knows, if you want to get started in a business, if you want to do something, then the best thing to do is just to get the shovel dirty. So for me, that was the way to stick my flag in the ground. God, all of these incredible cliches I'm coming out with. You have to cut them out in the edits. But so the Jobs Act's been a success. So just the round robin of the Jobs Act. First of all, Regulation 506C, which is Regulation D, Rule 506C rather, which enables you to publicly advertise private placements. So that was the first major step. And that enabled private placements that previously you could only discuss to people with whom you had a prior existing relationship. You were then able to advertise them to the world and his wife. And that's the first major step. And obviously there were some implications. You had to make sure that you could prove, as you still do, that the investors are accredited. The next iteration was, I think, was still waiting to see the full implications, the full positive implications. But the next iteration was Regulation A+. And Regulation A+ enables you to raise up to $50 million a year from an unlimited number of accredited and non-accredited investors. So that's a really useful entity. And Regulation CF, or Regulation Crowdfunding, was the final piece. And that really gave birth to all of the crowdfunding sites like Republic and all of those other companies that enable you to buy into potentially really exciting startups with as little as $100. So all of these changes have stimulated capital and have enabled people that otherwise wouldn't have been able to invest. It's really opened up the market. And people talk about democratizing investment, which I think is a very overused term. But what these platforms have done is create the ability for someone sitting at their armchair, on a Saturday afternoon, to get access to deals, primarily real estate, but all sorts of other deals that they wouldn't have been able to get access to. So it has been, I think, a resounding success. There have been failures along the way, but there are failures in any sort of new business. Sure. If you look at cryptocurrency, for example, the rise and fall of the ICO market. So the normal distribution curve, I think, applies certainly to crowdfunding, but ultimately, there are huge benefits, huge long-lasting benefits.
Right, and I want to definitely tip of the hat to the disruption that what the Jobs Act has done to the access to the average American. And not just average American, worldwide. Crowdfunding is now a massive platform across the world for different projects, specifically related to real estate. But it has been such a huge shift in the way people could access deals, right? And that thesis is working out, and it's playing out correctly in real life. Now, I mentioned earlier the nuances of some crowdfunding platforms, a big rush to market, and everyone thinks they're going to be able to capitalize on this. But to your point, you said before, is that raising capital is tough. So maybe you want to talk about some of the lessons you've learned in that raising capital process, and why, I don't want to harp on the failures, but why is it tough to get an online crowdfunding platform together in order to create, maybe is it trust, transparency, or is it still the very mano a mano? As an outsider, sort of as an operator, we've tried to use crowdfunding websites that haven't really worked in our favor. And we sort of boil it down to the fact that relationships, they just didn't know enough about us, right, as an operator. So what's your thoughts on that?
Well, I think crowdfunding really has a number of different components. So first of all, you have the technology. So you have the actual platform itself. So the platform is a web-based ability for someone to go and view something and buy something. Now, there are many other different platforms. There are non-investment platforms. There are platforms that enable you to buy stuff. Amazon, for example. But the reason you go to Amazon as opposed to somewhere else is because of the brand identity. Now, so even though you've got what crowdfunding legislation, what the Jobs Act enabled us to do, was enabled these platforms to operate in a legal and regulatory compliant way. What the Jobs Act didn't solve was the problem of, well, where do you get the investors from? So the reason that most of these platforms failed is because if you use the expression, if they build it, they will come, or if you build it, they will come, what happens is you build it and they don't come because finding investors is all about marketing. It's all about getting people to go to your website, navigate through your systems, and to have the confidence and the trust in both the platform itself and the investments that are on it to be able to part with your money. So the challenges are no greater than any other sort of consumer facing online product, because you've got the technology challenge, you have the regulatory challenge. Oh, and by the way, you have the most enormous challenge, which is getting people to use it. Right. So if you use crowdfunding sites in the expectation that by putting your deal on the site, that would unlock loads of capital, the reason it fails is because the relationships weren't there in the first place with the crowdfunding company.
Yep.
And many of these companies started off really just as a portal to give you a technological solution. So if you had a network, you could use this portal or this technology to enable those people to see your deals and to buy fractions of them. But the reason we see today a handful of crowdfunding sites is because of that natural wastage. But the sites that are available today have been hugely successful. Realty Mogul and Peer Street and Crowd Street and Alpha Flow, for example. These are all new platforms that are unlocking these markets because it's making it much more accessible. And my final point is, the Jobs Act is only a few years old, so we're trying to expect that this is an immediate overnight success. But I think as time goes by and as we move from one generation to the next generation are going to be much more used to looking for investments and looking for transactions online. So we will continue to see year-on-year increases in the amount of capital that is invested to the point where it will become the natural way of raising money as opposed to the traditional mano a mano private placements.
No, I completely agree. And relationships, coupled with, I remember you telling me one day, and all these things, sort of thoughts and memories are coming back after conversations I've had with you, both in person and on the last podcast, was that when starting a crowdfunding platform, it really is a bunch of marketing dollars you've got to deploy to create that relationship, to create that trust. Because without that, you're just another website, right? Like Amazon, how quickly you get to people trusting you is through education, and is through that buying of their trust. So the touches online, to be in front of them constantly 24/7. And the companies that had that staying power, i.e. the Amazons of the world that can, they buy the top of mind when you think about buying stuff online. On the real estate syndication side, on the crowdfunding side, the same applies, right? It's a bunch of marketing dollars up front and you've got to stay the course.
Well, it's a bit of both because, so here's the interesting scoop on real estate crowdfunding platforms is that only a percentage of the capital that is invested actually comes from the crowd. So in other words, I don't think there are any published figures, but each of these sites and each of the companies that have an online presence, a significant percentage of the business that they do is done through traditional off-market syndications. So that means that even though to the outside world, you would assume that all of the money that is raised comes from, the smaller investors. That's absolutely not the case. What these platforms provide is a shop window for institutional investors to be able to buy deals, because as you mentioned earlier, deal flow is the most critical component. It's not necessarily finding the capital. It's relatively easy to find capital once you've got that established deal flow. It's sort of, you get that, once you've got that momentum,
or credibility, right?
Then what happens? Yeah, you get the credibility. What happens is your problems change from how do I get my seed capital? It's now I've got all these people that want the yield that I've been able to demonstrate, because everybody wants yield, but now I can't find enough deals, because before I had deals and no money. Now I've got too much money and no deals. So what the crowdfunding platforms also found themselves solving was a major problem for multifamily offices and smaller institutional investors who wanted access to these deals that traditionally would be off market. And if you can package them up and present them in a platform where everything is managed by one sort of operator, then it becomes a lot easier. So the real estate crowdfunding companies are a mix of direct consumer finance, but also large percentage of their investment capital comes from small and medium-sized hedge funds and family offices.
And that's interesting, and probably something a lot of people don't actually know. And it again goes back to that marketing front of it has this very glossy image of I can access deals and I can come on here every single time. But to your point, it's the average investor who just jumps on one of those websites is a small percentage of what actually funds a deal versus a traditional fund or hedge fund, as you mentioned before.
At the moment, but again, I think if you look at the proliferation of online investment platforms, that's everything from fractionalized personal loans such as Prosper and Lending Club, all the way to real estate crowdfunding platforms, all the way to equity-based crowdfunding. Now, Regulation crowdfunding has only been around for, 2, 3, 4 years, something like that. And it takes time, because you have to build up the credibility that the companies that someone invested in 2 or 3 years ago are actually still here. So I think we are going to see more of a shift from, how else do people invest though? I mean, how do people find deals?
Right, exactly.
So
let's pivot a little bit and talk about Regulation CF. That was actually the first time I've heard it about Regulation CF. Maybe give a little bit of background on how that has come to evolve. Where has it different to the Jobs Act of 2012?
Well, it's all part of. So it was, I can't remember if it's Title 3 or Title 4, but there was the Jobs Act came out and said, okay, we're going to roll this out in stages. And the first stage was we're going to take traditional private placements, which is Regulation D offerings, and we're going to create a new Regulation D Rule 506C, which is the general solicitation rule, which we talked about before. Now, the other titles were Regulation A+, which I think is Title 4,
yep.
And Title 3, which is Regulation CF. Now, Regulation CF was the last one to come out of the gate, because obviously there was a lot more structuring that needed to be done. But Regulation CF enabled regulated crowdfunding portals. So you have to be registered with FINRA as a regulated crowdfunding portal. And that allows you to offer deals that have filed a Form C with the SEC. So rather than a Form D for Regulation D, it's Form C. So you file a Form C, and there's a few other hurdles you have to jump over in terms of how you present your accounts. But generally, it's almost like a public offering scaled down, where a company can raise up to $1.07 million a year from non-accredited investors. And what the platforms do is they provide the ability for you to invest. So they keep track of who the investors are and the money, and the escrow accounts that manages the flow. But most importantly, they're able to charge a commission based on the capital raised without having to be registered as a broker-dealer. So it's exciting, because you've got this new level of regulation that allows someone to set up a portal. They have to be regulated by FINRA or registered with FINRA. and approved by FINRA. But that allows them to earn commission on deals where they've helped people raise money, and they don't have to be a fully fledged broker dealer. And that's only sort of 2 to 3 years. So we saw a big rush of companies entering the space, and again you get that natural attrition. So the companies that are left now are really beginning to demonstrate some real success and some real traction in attracting large numbers of small investors who want to participate with a few $100s in these potential unicorns.
Right. And this is different to fund of funds, right? Which is, I know, more under the Regulation D, right?
Well, a Regulation D is a private placement. So a Regulation D is where typically it's used where you've got a relatively small number of investors. So there's a cap of 99 people or 90. So you can only have 99 investors in a Regulation D offering. Or it depends, so there are other restrictions. So if it's an LLC, there's 99. Caveat: do your own research.
Yep.
This is me just trying to remember stuff from years ago. And there are other issues. So if you get more than a certain number of investors, I think it's 3,000, then you have to become a public offering, and that's where Regulation A+ comes in, where you can have unlimited numbers of smaller investors. But Regulation D has always been the primary vehicle for private placements, and still today, hundreds of billions of dollars are invested through Regulation D offerings. Hedge funds typically run Regulation D offerings because they have a small number of investors.
Got it. Well, mate, I want to now pivot into QuantmRE because it's definitely something interesting we were talking about in the green room before we press record here. Do you want to give the listeners a bit of a rundown on how your take on single family equity and how to unlock it, and maybe what QuantmRE is set up to do?
Well, I think bearing in mind the audience, we can get into a bit more sort of technical detail. But yeah. So QuantmRE is a company I set up 2.5 years ago. What we do is we enable homeowners to unlock large amounts of capital from the equity in their home without having to borrow money. So that means if you are a homeowner, and you don't have to be an owner-occupier, it might be a residential home or a vacation let. But if you're a homeowner and you have significant equity in your home, we have the ability to invest in that equity without going on title. So we're not co-owners. So we have a structure that enables us to pay you a large lump sum up to $500,000 in exchange for a share of the appreciation in the property. So it's a very different mechanism to debt. And debt is where I lend you money secured against your property. I charge you an interest rate. You pay me back, month by month, or if it's a reverse mortgage, you pay me back at the end. But with our product, it is not a debt product. So what that means is that our underwriting is very different to the underwriting that you would have for a loan. And so that means we're able to invest in homeowners that have been turned down for a loan by the banks for whatever reason. So you may be in a situation where you have significant equity in your home, but you don't have any income. We can still provide you with hundreds of thousands of dollars of equity-based financing, even though you don't have an income. And so that solves a real problem for people that have equity, but either cannot borrow money from the banks or simply do not want to borrow money. Particularly in today's economy, where people are finding themselves in positions where they can't borrow money because their employment situation has changed, or the banks have increased the credit limit. So we help and have helped homeowners unlock millions of dollars, precisely in situations where they've been turned down by the banks.
And talk to me about the scale of this across the United States, because you were mentioning to me some figures before we press record again. It's quite a large amount of people who have this built up equity that can't necessarily go and lock it today. Well,
the number is just over $18 trillion. So there's $18 trillion, according to the sort of Fed's figures, of equity in single family homes. Now, some of those homes have 1 or 2% equity. Some of them are owned free and clear. So the total amount of equity is just about 18 trillion. Now, if you sort of drill down, if you look at the amount of equity that's accessible, in other words, people that have 50% or more equity, there are just under 15 million homes in the US where the owners have 50% or more equity. So think of all those people that have been paying off their mortgages for years, have built up this equity position, or people that own their homes free and clear. So the amount of accessible equity just in the senior market is $7-8 trillion. So and now let's talk about this in terms of capital stack. So in a commercial transaction, we were talking about this earlier, in a commercial transaction, you have a number of different financing layers. So, you start with senior debt, then you have junior debt, and you might have, 2 or 3 layers of junior debt. You have mezzanine, which is a combination of debt and equity. Then you have preferred equity, and then you have equity. And there's all sorts of, variations in between. So you have people that have capital that is lent to a commercial enterprise secured against the real estate. Then you have equity investors that have absolutely no interest payments. Their exposure is entirely an equity exposure, but they get normally a higher upside because there's more risk. But the difference between debt and equity is fish versus fowl, 2 very different instruments. In a traditional residential home, at the moment, the only way you can fund or finance a home is through debt. So there are no commercial operations of any scale that enable there to be some sort of equity participation. There are edge cases where you've got sort of tenancy and common schemes, but they're a tiny fraction of a percentage, so they are statistically not important. So from a homeowner, if you are sitting on $500,000 of equity, for example, in your $1 million home, to you that represents a concentrated, single, non-financial, non-liquid, non-cash flowing asset. So the only way currently that you can access that asset is to borrow against it. So we're changing that model by saying, okay, we have an investment agreement which is structured very similar to an option, where we're saying we're interested in participating in some of the potential future increase of that property in the same way that if we were taking part in your commercial transaction, we'd be buyers in the equity piece. So we structure the same sort of arrangement with the homeowner. So the homeowner gets a lump sum, which can be tax deferred because it's based on a future settlement. So the homeowner gets use of 100-cent dollars, and they've got up to 30 years to settle the contract by selling the home or by refinancing us. But in the meantime, as the house appreciates, as the owners of that option, when the homeowner sells, we get a share of that appreciation. And in order to make it compelling for our investors, we get an augmented or a magnified share of that appreciation compared to the amount of investment that we initially made. So from an investment perspective, it's compelling because I get a share of the upside. From the homeowner's perspective, it's compelling too because I get a cash lump sum that I can spend on whatever I want. Because it's not debt, guess what? There's no monthly payments. There's no interest. It doesn't appear on my credit report as debt. And I can use the money for whatever I want. And that could be to fund another real estate transaction, or it could be simply to pay off some expensive, credit card debt.
It's a very interesting model because I've got a couple of questions for you on this. So the first question is from an investment side of view, who's attracted to these types of deals? Because without that, so everyone wants cash flow. It seems that everyone wants cash flow, cash flow, cash flow, cash flow, cash flow. Who are those people who just want to, place it and forget it and come back to it in, 20, 30 years time?
Well, again, let's look at the scale of the market. So again, it's an $18 trillion marketplace. So this is not a niche play. So that means potentially it's interesting to large pension funds, endowment funds, long-term capital plays who are looking for an inflation hedge or who have a certain capital allocation that is designed to be invested in these sort of long-term foundational investments. So our investments represent a structurally leveraged return on the house price index. Now, because of the returns that our investors get, they don't just get the same return. They're almost in a preferred equity position. Correct. So they get a better return than the equity players. And there's a an agreement that the homeowner signs, which makes that very clear what that is. But because of that, that means that the investors can see if you have the ability to forecast what the house price index is likely to be, then that means that you can very clearly show what the likely return is going to be based on this asset class, because it's a highly distributed asset class. So all of these investments are individual properties. So you don't have that concentration risk. You're also able to invest across different geographies, different economies throughout the United States. And what you're getting is a fairly stable inflation hedge with that sort of structurally leveraged upside. So from an investor's perspective, if cash flow or cash pay is not important, this is a fabulous investment that traditionally has outperformed many of the comparable investments. So it's not correlated to stock market returns. It has a very low volatility. It has a very low drawdown compared to other investments. So as an asset class, it's a very solid investment. But my final point is that the average duration of these contracts is not 30 years. So what we're seeing is that these contracts tend to sort of terminate, or they tend to be finalized when the house is sold, and houses are normally sold every sort of 5 to 7 years. So it follows that same life cycle. So the actual duration of these contracts is not terribly long. So the investors are likely to get their capital back much earlier than that full 30-year term.
And you mentioned earlier, it sounds like you're going out to massive, you said endowment funds and pension funds that are mitigating their risk over many, many deals. I'm assuming it's hundreds of deals. Do you take on the individual investor for a one-on-one type of deal, or is it just purely the big players?
Well, I think so our plan is to do this in stages. So the first stage is to prime the pumps with institutional capital, because that gives you the big hammer. So that gives us the ability to go out and originate large numbers of transactions. Now, part of our roadmap is to leverage the sort of crowdfunding ability, and to leverage all the regulations that allow that, to say, okay, we have the ability to originate these transactions. Let's see if these want to be funded by the crowd as well. So on one hand, we'll have the institutional capital, but on the other side, we want to make these investments available to smaller investors, and it'll be accredited investors to start. And then as we change the regulations under which we operate, we expect to be able to offer this to non-accredited investors under Regulation A+. So our roadmap, our plan is, first of all, to make these available to institutions, which they are right now. Secondly, to make them available to smaller investors. So someone with literally a few $100s will be able to buy a fraction of one of these home equity agreements. Our longer term strategy, which is sort of 2 to 3 years, is to create a secondary market, which is where people can buy and sell these fractionalized interests. And the interesting thing is that when it comes to pricing, every month we plan to reprice these agreements based on movement in the underlying house price index.
Got it.
So we can reprice these contracts every month, and you'll be able to see if this agreement's gone up in value. If it has, you could potentially put it up for sale. You could sell some or all of your investments. So our plan is to make home equity accessible, investable, and tradable. So we're already knee deep in phase 1. Phase 2, which is this investable to a wider audience, we're hoping to start that process in the middle of next year.
Well, and it goes back to your point before about the crowdfunding statement that a small percentage of crowdfunding websites actually are funded through the individuals. It's actually backstopped with the institution. And I think it seems like that's the playbook, right? You go out, you get your book of business of institutional guys, whatever the particular widget is. In your case, it's very niche to unlocking single family house equity, and then proving the concept, and then knowing that you can offer a portion of the offering to the smaller investors who want to get a piece of the action alongside these bigger institutional groups. Is that a kind of summary?
It is, but I think what's happening though is that the numbers are changing. So the ratio between institutional and I suppose commercial or consumer retail finance, it's not static. So it's not always going to be that ratio. Historically, it's been in favor of institutions. That's only because the average consumer, it takes time to build that type of trust and credibility up. And I think where we are now is we're seeing, more and more platforms have been established for a number of years now. So there is that trust and credibility. And because of that, we will see a shift. Well, one of two things will happen. Either you'll see a rebalancing, so there'll be more consumer finance as opposed to institution. I think what's actually going to happen is the overall bucket's going to expand. So more and more capital is going to go in, more from institutions and more from consumer finance, because it's just so easy to add, as technology moves on, evolves. Thank you. It's a lot easier to have platforms that now speak to multiple platforms. If you think about it from companies like Robinhood, for example, that give you access to a whole range of different investments, whether it be crypto investments or fiat investments or shares, where you can build portfolios of really bespoke combinations of publicly traded entities and privately traded entities. So I think we have all of that to look forward to. So, and again, we're just at the very beginning of all of this. The Jobs Act sort of started it, but we're now beginning to see the flywheel, pick up its own momentum.
It's very interesting, and it's such an incredible part or wave to be a part of, right? You're riding that wave of the Jobs Act and into the future and beyond. And I think you're correct that it's going to get bigger and bigger as people become more and more used to, the generations get older and they get more used to investing online and away from maybe not necessarily the mano probably never stopped, but with the large check sizes, but the smaller guys getting involved in what we call alternative investments outside the stock market is only going to continue to grow, and the appetite's going to continue to grow. On the other side of the piece, what are you qualifying the houses for? How do you get the sort of the pipeline full with product and the deals? And is there a specific criteria? I'm assuming you're looking at high appreciation markets, maybe like the coastal markets, in order to tap into that equity.
Well, the answer is yes. It is exactly that. So it's a combination. So we're underwriting houses primarily in markets where there is likely to be house price appreciation. So we do operate in 32 states. So we are able to offer programs in 32 states. Now, that's probably not going to increase because there are a number of states where, unfortunately, you simply don't get the sort of appreciation that you get in other states.
Right.
So we're not focused on pure appreciation such as the coastal cities in California, for example, where it's a much broader brush than that. But what we're looking for is homes where the homeowner normally has around 40-50% equity in the homes. So we're looking for homeowners that already have a significant equity position, and we will invest up to 20% of the current value of the home. And the maximum that we will go to, including any existing leverage on the home, is 70%. So after our investment, the homeowner will always be left with 30% or more equity in the home. So this is absolutely not a situation where we're over leveraging homeowners. What we're doing is we're providing homeowners with the ability to move money out of their equity account into their bank account. So it's really just, if you think about it that way, but we do make sure that we leave the homeowner with significant ownership in the property. And again, the way our instruments work is that it's not, we don't sit on title as an owner, so it's not a tenancy in common. It doesn't trigger any property tax revaluations. It's a personal contract with us and the homeowner. It is protected by a lien on title. So we are part of the escrow process. So we do sit in a junior position. So that lien helps protect our investment. But, we're not there as someone who's going to insist that you lend us your spare bedroom one afternoon.
And I assume you'd have caveats in and around they can't go and place additional debt on top of that, right? That's
the primary caveat, which is that our position is an equity-based position. So what you cannot do is increase the leverage without our permission. And we do allow that as long as the leverage, the equity position that we've got is within that 70% tolerance.
Yep.
And obviously, if you want to refinance, that's not normally a problem. But because we sit there as a lien holder, that gives us the ability to protect our position. But it does make sense, obviously, that we wouldn't want a homeowner to be able to leverage the home so that our position is is weakened.
Love it, mate. Well, look, sounds like you've got such an incredible future ahead, and I love the iterations that you've come through CrowdVenture, and I encourage those people who haven't listened to episode number, I think it was 26 or 23, go back and have a listen to that one, and interesting around your explanation, Matthew, on the Jobs Act and how it's evolved, coming now full circle 4 years later to talk about the evolution of it and into such a niche market that you've identified with QuantmRE. I think it's quite fascinating.
It is. And also it's actually slightly worrying because if you can actually go back, it's like, do you remember you said this 4 years ago? It's like, I did believe it at the time, but it's amazing.
Well, I do remember that comment about the marketing, it's a marketing company, crowdfunding platforms. I remember that it came to my mind as I'm talking to you, because I vividly remember you saying that there's just a ton of marketing dollars in the beginning to get that trust.
I would just like to beg forgiveness from the listeners. If I did get most of it wrong, it's because my 2020 vision, forward-looking lenses were, at the menders that day.
Well, that's a segue sort of into summarizing and the wrapping up this show is, what is the vision for the next couple of years? It's changed so significantly in the last 4 years, and I think that's the beauty of being an entrepreneur. But what do you have a crystal ball?
Yeah. Well, I think it's evolved. So I think the important thing is that what we've been involved in has been this sort of step-by-step evolution. I'm always, change is something that sort of makes me shudder, because I think, well, what are you doing? Are you doing this or that? So I think what we've done is, it's been an evolution. So, thank goodness for that. So it's not so much a pivot, but it's like, well, okay, this is where this is taking us. It's all along the same sort of path. So what we've done is we've been able to build on all of the experiences along the way. But you're right, the business is different now to what it was, but it has, 99.762% of the same, ingredients. But I think going forwards, the demand for cash is going to get greater and greater, because the uncertainty that's been created by COVID, the big thing that's changed is COVID. So COVID has really lifted the lid on a lot of things that we thought were sacred, and has made us feel very nervous about things that previously we felt very safe with, very, very secure with. And home equity is one of those things that previously people were content to have it sit there and accrue without even thinking about touching it. Now they don't feel anywhere near as confident that their houses are going to be worth something predictable. And so they're much more willing to look at that. And because of that, that is going to give birth to a significant increase in the types of alternative funding arrangements for homeowners. So my vision for the future is that we will see more and more options and a greater adoption of funding, the sort of funding that we provide, which is alternative equity-based funding, because there's such an untapped amount of equity that needs to be, needs to be addressed, and there is such an inherent demand from homeowners. So I think it's positive, because this change that's been set about by COVID, is going to create a lot of disruption and a lot of things that previously we took for granted, I think, are going to change, and it's going to be to the benefit, significant benefit of the homeowner and the consumer generally.
Well, I do love what you just said there and I agree with your sentiments on the second part of that statement. But the first part of, you're not changing, you're pivoting. And we're all doing that as business owners, right? We're all pivoting over time. And if you're not pivoting, if you're not changing, then you're failing, right?
But sort of iterating. I think the word I love is iterating, because you're moving. I mean, iterating, as in, it comes from the Latin word to run, doesn't it?
Mm-hmm.
So you're, the more momentum you have, the more fine tuning there is, the more you listen to what's happening out there, and you change your business model, because your business model hasn't, you've evolved over the last 4 years. Otherwise you wouldn't get anywhere.
Exactly.
So I think that's what we all do. That's what we will have to do is listen to what's happening and tweak everything to make sure that we're always, in tune.
Exactly, 100%. Mate, at the end of every show, if you do remember, we'd like to do the lightning round. It's called the top 5 investing tips. You ready to get into it?
I completely forgot about that.
No, so I'll remind you.
Judicious use of the edit button is required. Yeah.
Well, I remember I asked these 5 questions. It's the same 5 questions, just with sort of quick, sharp answers. to these 5 questions that I ask all my guests. So let's get into it. The number one question, or the first question I should say, is what's your daily habit you practice to keep on track towards your goals?
Just get out of the office. Okay, so what I used to do is get up, rub my eyes, and immediately start trying to focus on my computer to see what was happening. So that's a really stupid thing to do. So the first thing to do is just get out of the house, go for a walk. Just do some, what is that expression?
Exercise.
Physical exercise. There you go. So no, I mean, I love that, and I swore that I would never be one of those people that would talk about the benefits of breathing fresh air in the morning, but actually it's quite a good idea. So my habit is just get out and go for a walk, have half an hour thinking time, rather than just throwing yourself straight into the sort of the electronic abyss.
Yeah, completely agree. It's such a drag, and it can drag down in your day if you don't have that time in the morning for yourself. Love it. Question number 2: who's been the most influential person in your career?
Okay, so I have a friend, Stephen Partridge Hicks. There you go. You've been named. So I've known him for probably 20 years. Hugely successful banker, and just generally one of the smartest people that I've ever met. One of the most, kind, generous. It's the whole sort of combination. So I am still, insanely envious of everything that he's done. But he does drive me forward because I want to be like him. I want to be successful like him. I want to, not because I want the things that he has, but I want to do a good job. I want to,
leave a legacy.
Exactly. You want to build something. I mean, so I've avoided people like Richard Branson and all that sort of stuff. I mean, I've met the guys; they're great. I never knew them well. So you only get to see the veneer. I mean, I worked with him for a few years, but I have someone that no one ever knows, but he was a very, very successful UK based banker. Still one of my closest friends.
Love it.
Absolutely useless information to anyone listening here who won't know him, but there you are.
Love it. Well, it's all personal, mate. That's the beauty of this show. Question number 3: what is the most influential tool that you use on a daily basis? And when I say tool, it could be a physical tool like a phone or a journal, or it could be a digital tool like a piece of software that you can't run your business without. What is it?
It's this. It's a book. Okay, so I'm not trying to be funny because everyone's got the business. I've tried all these various different, but I just like writing stuff down. I like the connection of, thinking something and just the art of, trying to get this pen to sort of, write something that I can read the following morning. But it is therapeutic. It's analog. And it has so many benefits, right? Because it's not screen based.
Right.
So I write stuff down. This is what I want to do today. And even though I'm repeating most of what I had yesterday, because one of those days where you didn't get anything done, it's just the formation of the letters and the putting of the ink on the paper that creates this sort of this bond with you in the book that you have to do what you've written down there.
100%. I got exactly the same thing. If anyone's watching, it's pages and pages of notes. I bought 50 copies of these things to give away, but I misspelt something on the front cover, so I have to use them myself. But it's great. It's the art of writing something down. And I really get a kick out of it. As a small little win. The crossing it off is
The
crossing it off.
You can do like wavy line crosses,
yes,
or double crosses, or a check, or it's like
exactly. Love it. Question number 4 as we wrap up here. In one sentence, what's been the biggest failure in your career? What did you learn from that failure?
Oh, just saying no when I should have said yes. People go, oh no, I couldn't possibly do that. No, it's not for me. Or no, I'm not the right person to do that. Or no, it'd be too much. Just say yes to everything and then figure out how to do it afterwards.
Fake it till you make it, right?
Well, no. Actually, the opposite. No, not say yes. Sorry. You can do things. I mean, that's very different. That's something I would not do. I mean, if you can't do something, then obviously don't tell someone you can. But if someone offers you something, or like an opportunity,
right? Got it.
I've turned so much stuff down because maybe I didn't have the confidence in myself, or maybe I didn't have the far-sightedness to see where it was going to go. So if someone offers you an opportunity, the answer should always be yes. and then figure out later on in the day, if it's not something you want, you can always back out afterwards. But don't turn stuff down because of the way you think it's going to turn out.
Right.
Let it take its course, and maybe make a decision a bit further on. So my regrets is I've turned stuff down which I shouldn't have done, for a number of reasons. And it's not a regret. It's just I should, I'm much older now, so I'm much more open-minded, and and I don't, I realize that I'm really nowhere near as good as I used to think I was, and so because of that, you tend to sort of are much more open-minded to the abilities of other people and the offers that other people are making. And so yes is now my usual expression.
Well, I think you hit the nail on the head there. It's the betting, the being okay to bet on yourself that you can do it, right? And that's the self-doubt that comes into it. There's a whole other topic, but when you say no, it's like, I'm so self-deprecating. No, I can't do that. I could never possibly do that. And you're like, no, you can. You just don't go figure it out once you say the yes.
You don't know how to do it. Yeah, exactly. But the thing is, it's a pathway. Like as you take one step, the next step becomes clear. Sometimes,
or you're worried about the failure or the judgment or whatever it might be, and so you always say no and not actually say yes, and start pushing the boundaries of what you're comfortable doing.
And the easiest way to fix that is just to say yes. If someone offers you, so to go yes.
Sure, let's do it. Yeah. Love it. Last question, mate, is where can people reach you to continue the conversation? They want to be in your sphere. Where do they go?
2 places right now. The first is QuantmRE.com. So everything is there. All of our press, contact details, everything about the company, how to apply to get equity from your home. So that's QuantmRE, QuantmRE.com. We're also raising capital on Republic. So if you want to own a piece of QuantmRE, our crowdfunding campaign is live until the end of September. So you can go to republic.co and then search for QuantmRE, and we'll be there. So if you fancy owning a piece, and if you would like me to be, entirely, subject to your wills as a shareholder in the company, then please, invest generously on the crowdfunding side.
Love it, mate. Well, look, I want to thank you so much for jumping on the show once again. You're a good friend of the show. I just want to quickly summarize what some of the things I took away from today's show. I think the biggest one is pivoting. Knowing you for so many years now and having the history of getting to know one another, I think it's a tip of the hat to you to be malleable in your approach to business and knowing when to change and be that surfer on that wave and ride it, as things come up. I think it's really important as entrepreneurs to never stop changing, never stop pivoting, and never stop evolving, because once you do stop that, you will then ultimately be surpassed by technology or something else that will come and consume you. And that's we're in the business of continuing to evolve. And I think that's probably the number one thing I've taken away from today's show.
Great, thank you. And I think and that's it. And I think that's the life is actually a lot simpler. As you get older, you realize actually it's not actually that complicated. You just got to do a few simple things well.
Exactly.
If only we knew what they were.
Exactly. And if only we had a crystal ball to look ahead and make those,
or an instruction manual or something. I'm still searching.
Exactly. Well, mate, look, thank you so much for taking some time out of your day. Enjoy the rest of your week, and we'll catch up very, very soon.
Lovely, Reed. Thank you for having me on. It's been marvelous.
Well, there you have another cracking episode jam-packed with a really good friend of the show, Matthew Sullivan. If you do want to check out any of his stuff, please head over to QuantmRE.com. Remember, he is raising capital for equity in his business. So if you're interested in that, go over to republic.com, I think it is, and check out all the offerings over there. I want to thank you all again for taking some time out of your day to continue to grow your financial IQ. If you do like this show, the easiest way to give back is to give us a 5-star review on iTunes. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.